Good morning. Has there been a little bit of price increases because of the price pressure you've been seeing in terms of input costs for your pizzas?
We have, but what we've taken is a real customer-centric mindset. So we came into this knowing that our prices move in 6 and 12 months blocks. So we knew that from January we would take some inflation, and what we worked on was what we call a more for more program. So we've decided to focus on innovation, that if we are going to take price anywhere, we're going to give the customer more for that price. We've been launching some premium crusts, which lift our basket. We've been lifting the quality of some of our ingredients. We've been putting some more topping on some of our pizzas in different ranges. So we're really focused that we're not simply going to charge more for the exact same product. If you're going to end up paying a little bit more in your basket for your food order, then you're going to get more with that. And overall, we'll be able to take on that inflation as a result.
And it hasn't just been inflation. Obviously, you're dealing with what pretty much every employer is dealing with at the moment as well in terms of labour shortages. Can you give us a bit of a guide as to how that's been playing out in the different regions? Because obviously Australia and New Zealand will be a bit different from Japan, a bit different from Europe.
Yeah, probably the market that's had the most tension for us has been Germany, where we've been under the most pressure. But saying that, across our business, what I'm so proud about is our delivery times continue to improve, despite the fact that we had record sales. The other thing, if I pick the Australian market, we had a record increase in our payroll numbers. That means the number of people that entered our payroll in December, which also coincided with record sales throughout the Australian business. And we've highlighted that in recent months, the Australian business, the Benelux business, so the Netherlands and Belgium, Luxembourg, and the Taiwan business are the outliers for just doing extraordinarily good numbers. And we've been actually able to staff those businesses a little better than and having a little less challenge than in some of the other markets. So right now, I think it's because we've been focused on this 10-minute delivery model, where we're able to do more deliveries per hour than anybody else. Therefore, we're actually able to be more efficient than anybody else, which is also going to give us the ability that we can pay more than anybody else. I'll give you an example. If we do 4 deliveries an hour, in the last year, and if we're migrating towards 5 deliveries an hour, we can afford to pay 25% more and actually still have the same cost base. So whilst delivery doesn't move in a pure single order per hour more, and we see it more like it goes from 4 to 4.1 to 4.2 and 4.3, but that also gives us the room to be able to pay more, because we think also we believe this is the age of delivery. We said that pre the pandemic, that by the end of this decade, 50% of all retail food will be delivered. And there's not enough human beings on the planet to deliver that many packages and that many orders. And so therefore, the winner at the end of this decade will be the most efficient. And if we're not efficient, if the industry isn't efficient, then we'll actually drive down the number of orders, that people will choose other choices. But at Domino's, we're obsessed that we're going to be the most efficient and do more orders per hour and be able to pay more and take more market share.